way people think about risk has an enormous impact on the market, and it changes volatilely. And people are supposed to be these computers who look at risk-adjusted returns and make intelligent decisions on that basis, and nothing could be further from the truth. When the market is doing well, the economy is thriving, and companies are reporting good profits, and the media are telling good stories, and everybody feels good, what do they say? Risk is my friend. The more risk you take, the more money you make. And I feel entirely comfortable taking risk today. And by the way, I don't see any risks on the horizon. So bring it on. And then, for the next year or two, the economy suffers, corporation profits disappoint, the media now turned into telling scare stories, the prices are cascading down, and emotion goes through the floor. And now what do people say? Risk-bearing is just another way to lose money. I don't care if I ever make a penny in the market again. I just don't want to lose any more. Get me out at any price. And this fluctuation in attitudes towards risks probably does more than any other one thing. Risk aversion. Risk aversion is not a concept that most people think about every day, but it's extremely important. And most people are afraid of losses. That is to say, they are risk averse. And for most people, if they make 1,000 euros, they're okay. But if they lose 1,000 euros, they feel terrible. So the losses count more than the gains for most people. So most people are biased towards risk aversion. And risk aversion is a very, very important ingredient in the markets. When people are risk averse, as they should be, then what happens? If they consider an investment, they study it thoroughly. They make only conservative assumptions. They are rigorous in their analysis. They demand a margin, what we call a margin of safety. I want to be sure that if things go poorly, I'll be okay. And they demand risk compensation. If they're going to do something which is risky, they demand an exceptional return as a potential reward. So when we have risk aversion and we have conservatism and caution and diligence and demands for risk premiums, then we can say that the market is safe and sane. But when people get excited about the future and they get excited about what's been going on, they forget to be risk averse. They become risk tolerant. They become accepting of risk. And when they do, what happens? They say, well, it's not so important to do due diligence and to make conservative assumptions, because if I'm too careful, then I will miss something and my friend will get it. And you know, there's a book by a man named Kindleberger who says there is nothing worse for your mental condition than to watch a friend get rich. And eventually in the market, fear of missing out takes over from fear of losing money, and then people do bad things. So we have to understand whether the market is based on risk aversion or on risk tolerance. And when it's risk tolerance, because people are excited, then we have to understand that the market can be a dangerous